Sorry about that, guys. Okay, we are back. Thanks. So, what we're witnessing right now is a major black swan event, I think, is building up, and we're about to reach a tipping point in the markets. This is going to be something very different to just, a normal recession, to a normal market sell off. We are seeing things get very, very bad. And I've got story after story to prove to you things are getting very, very bad indeed. Now, I wanted to get this news out to you yesterday, but I've been sick. But the show must go on because this is so urgent of what I've got to tell you. So, okay, everyone, without further ado, you know what time it is. Let's get straight into the news, the facts, and the data. So, look at this. Bond sell-off grinds as oil tests $94 a barrel. So we're seeing something very, very interesting happening in the markets right now. We're seeing oil go up at the same time yields on bonds are going up. This is something that doesn't normally happen, okay? Go ahead and look at this. The 10-year yield is at 4.6%, okay? I'm just having a look here at the chat. And if this hits 5%, we're definitely going to see something break in the financial system. And this is what I've been warning about. But also, at the same time, look at this, oil. Oil is surging. So if oil goes above $100 a barrel, we're going to see inflation continue to surge. And whether the Federal Reserve likes it or not, they're going to have to keep on lifting interest rates. But what is this causing? Well, look at this. This is the TLT, iShares 20-year plus Treasury yield bond ETF. And just have a look at how much it has tanked since interest rates were at their peak, at the bottom. We can see here they're down 47%. That's right. Government bonds, which are meant to be the most safest assets, are going actually 48% from their peak. Now, if interest rates on 10-year hits 5%, it may be a good buying opportunity, because if they fall below 50%, it may be a steal, unless we see a full-on debt default with the government, which is becoming more and more likely. Because let's go to our next story. There was a lot that happened in the markets yesterday that we need to talk about. And because I'm unwell, I hope my voice holds up. But I'm going to have to, push through this because this is very, very important, everyone. So data showed consumer confidence dropped to 103. And this, what have I been talking about, everyone? They revised it from 108.7 in August. So this is what they keep doing again and again and again. Now, put out this amazing number. Bidenomics, the economy is booming. Consumer confidence is so high. You guys are rich. You're just drowning in cash because you're going out there and spending like crazy. Your balance sheets are so strong. Well, of course, they revise it the next month quietly. And they missed the medium estimate of 105.5 in a Bloomberg survey of economists. So separate reports also showed that the purchases of new homes fell to a 5-month low, while home prices in the US rose to a record high over the summer as buyers battled over tight supply. So again, this is just a matter of time before more supply comes on the market in the US before we see a housing downturn. The numbers right now, if you're an investor to buy real estate and to rent it out, just don't make sense. The cash flows don't make sense. Also, at the same time, Costco, our quarterly report showed comparable sales that mostly trailed analyst estimates, suggesting shoppers are cutting back on discretionary spending. And that's something we're definitely seeing right now. Now, while the Fed is focused mainly on core, the average consumer is spending a substantial portion of their budget on food and energy and are unwilling to ignore those prices. So that's exactly right. The central banks try to gaslight you and tell you, look, food and energy, that's not important. It's volatile. Well, yes, it's volatile, but if you look over the past 10 years, it's only gone up, okay? So these are very, very important. And if they keep going up, they can't just keep on excluding these because this is essential for people's survival. So they need to take these price increases on food and energy into a factor. Otherwise, this inflation problem will about to get much, much worse. Now, also, okay, like I warned about, we're seeing something very, very worrying happening in the Treasury market. And I think that's because we're seeing a lot of foreign central banks are selling bonds like China and Japan. At the same time, the Federal Reserve is doing quantitative tightening. So even if the Federal Reserve doesn't lift interest rates, if bond yields keep rising, okay, interest rates will go up, whether the Federal Reserve lifts them or not. So yields on treasuries drifted back up after reaching a decade high on Monday. A 48 billion treasury auction of 2-year notes was awarded at 5.085%. That's right, the 2 years over 5% now. This is the highest since 2006. So again, we're seeing a lot of the build-up, like what happened in 2006 before 2008 happened now. Now, this doesn't happen overnight, people. This could play out, or has been playing out for a couple of years, but the event inevitable will happen. So also, a lot of the tech giants, they've been plunging. They're down 10% from their July peak. The Federal Reserve speakers have come out and they've said that he expects the US Central Bank will need to raise interest rates one more time this year. Well, I think they need to lift them much more than that. But the thing is, they won't do it. So thanks for that super chat, Frank, by gold, silver, and platinum. Why it's cheap. Yeah, definitely a good option. So this is leading investors to realize that higher for longer interest rate environment is a likely outcome and are slowly adjusting to the new normal. Okay, that's been the mantra for the Fed for the past few months, and the markets are now finally starting to get the picture. Okay, we've got so much more news. Look at this. This is more systemic things that I think will lead to a black swan event. Not just what will happen in the markets, but what's happening in the US with a culture war, with a lawlessness, with morals deteriorating, okay? Target says it will close 9 stores in major cities, citing violence and theft. Wait till you see where people don't have enough money to eat people. They don't have enough money to get a roof over their head. They don't have enough money to fill their car up with gas. This is what it leads to, okay? Obviously, there's people, opportunists, which are taking advantage of the soft laws in these democratic cities. But look at this. Target said it will close 9 stores across the country after struggling with crime and safety threats at those locations. Target, which nearly has 2,000 stores in the US, has been outspoken about organized retail crime at its stores and said that theft has driven higher levels of shrink. So shrink is, I guess you could say, the political correct word for theft. Target is closing stores in New York City, Seattle, San Francisco, and Portland. So again, all cities that have become very, very woke. You know what they say, you go woke, you go broke. Look what happened. If any of Victorians are watching here, we've seen what happened with Victoria. Victoria's extremely in debt now. Dan Andrews just resigned the other day. He's turned the state from in debt of around $50 billion to $200 billion. And you know what they say, go woke, go broke. Well, this is happening now. We're going to see a lot of major businesses leave these cities unless something is done. And I think it will eventually happen once these politicians start losing millions in donations. So something else that is also spooking the markets right now. The Federal Reserve, Neil Kashkari, came out yesterday. There's my voice starting to go. Come on, Michael, push on for the viewers. I'll push on as much as I can, people. So Fed's Neil Kashkari sees 40% chance of meaningful higher interest rates, okay? So he said there's about a 50-50 chance the interest rates need to go significantly higher. Not just one more rate hike, okay? They need to go significantly higher. Not just him. JP Morgan, Jamie Dimon, which again, not that you got to take everything he says with a grain of salt. Obviously, he's trying to manipulate the markets. But what he's saying here is true. So Dimon warns that the Fed could still raise rates sharply from here. He commented, he's not sure the world is prepared for 7% interest rates. And if the Federal Reserve did what they needed to do, interest rates would be at 7% right now. But central banks actually need inflation because look at the US government. They're in $33 trillion worth of debt. Interest rates on that debt is approaching 5%. It is going to be their biggest expense. The only possible way, not even to repay the debt, but just to keep servicing it, they need inflation. So that way it pushes you up, it pushes your wages up. But what does that also do? It pushes you into the next tax bracket and you start paying more tax. So, that's why they always start with let's tax the rich. But what happens if in 10 years' time we have hyperinflation, everyone's earning $1 million. That's just a medium income, and loaf of bread is $50, and you'll all be paying 40% tax. That's the really only way out of this scenario is to inflate the debt away. Now, also something that's worrying the markets right now is looming shutdown turns up the heat on stocks at a bad time. So investors, Fed stare at possible blackouts of key economic data. So could this just be an excuse, everyone? Right at a time when the data is about to get very, very bad, they may shut down all economic data and say, look, you know what? We're struggling for money. We can't afford to pay these economists. We're going to shut down the data. You know, the data has already been so bad in the US. It's, you know, might as well just be as bad as China right now. And at the time when things are about to get very, very bad and you need to be informed, all data may be shut off. So it says here, with this much uncertainty in the air, a shutdown would present another curveball that investors and the Federal Reserve will need to contend with, particularly since certain economic data could be delayed, including those on unemployment or employment and inflation. So, okay, the unemployment rate could skyrocket, inflation could skyrocket, but they're like, oh, look, you know, we can't report the data, so who knows how bad it really is. So this is what's going to happen. So if the Senate is unable to reach a deal this week, the government will shut down on October 1st, people familiar with the talk say, and the parties are nearing an agreement on short-term spending measures. So that could create headwinds for companies dependent on government interaction and services, such as defense suppliers and other government contractors. And taken together, this can provide investors a convenient excuse to avoid riskier assets in the short term. He said the S&P 500 dropped 15% in the first few weeks of December 2018 prior to that shutdown. So if there is a shutdown, could we see a similar thing happen? The S&P 500 crashed 15%. Now, again, this could lead to a big black swan event. This is what I'm talking about. US risk, its top credit rating was shut down, Moody's warns. So they already got downgraded early in the year by S&P, and now Moody's is looking at the way how disastrous the US government is going, with them not being able to get anything done, with them taking on so much debt, and they're warning that if things keep on going the way they are, there could be another credit rating downgraded. And again, even if the Federal Reserve doesn't lift interest rates, if they get a credit rating downgrade, interest rates on bonds will skyrocket, so your mortgage rates, your credit card rates will skyrocket as well. So they say here, a government shutdown will demonstrate the significant constraints that intensifying political polarization continue to put on U.S. fiscal policy making during a period of declining fiscal strength, driven by persistent fiscal deficits, we're seeing the deficit skyrocket, and deteriorating debt affordability. That's what Moody said. Okay, this is from them themselves. That's exactly right. The debt costs are skyrocketing and it's getting out of hand. Markets have been on watch for further credit actions after Fitch ratings downgraded the US back in August, citing concerns about political wrangling over the debt ceiling that took the nation to the brink of a default. So eventually, guys, they can't keep doing this forever. And you may think, well, look, they can just keep kicking the can down the road forever. No, they can't. And even if they do, there will be another consequence from that, hyperinflation. If they just keep on taking on more and more debt, we will eventually have hyperinflation with the US dollar. So Moody's latest report, which leaves its rating of the US unchanged, is a sign that US debt sustainability and the politics around it will continue to be a theme throughout the remainder of the year. Now, another black swan event. Let me just have a sip of water here. So, Jamie Dimon also warns, we've dealt with recessions before, but he says geopolitics is the world's biggest risk. And that's exactly right. If we enter if the situation between the US and China continues to escalate, their relationship gets worse, which is happening, well, we could see a huge contraction in global growth if these two massive trading partners stop working together. So that is another big risk. It could lead to a major black swan event if, we don't want it to happen if World War III breaks out, which we definitely don't want to happen. If the situation with Russia keeps on getting worse, that will mean there'll be more supply shortages. If there's more sanctions, okay, prices of oil will keep on going up. But here's next. At the same time, we're going to have a lot of students or a lot of young people have to start repaying their student loans. And that's going, and this starts next week. And that's going to be a lot of money taken out of the economy. Money that will be spent on a lot of goods, businesses. That's not going to happen anymore. And we're going to see companies' earnings fall. And I think the stock market has to start to price this in. So everyone, there's a lot of important news today. What do you think about this? Definitely a lot of risk happening in the bond market, with oil, with the economy, with geopolitical risks. What do you all think? Look at your guys' comments in the chat. Thanks for watching. You've been awesome. I'll see you all in the next video.